SBA loans, they're starting to fail, and that's not a good thing. It signals that the economy is in much worse shape than we thought. Again, we're going to take a look at an article from Barron's today where they cover an internal risk analysis that's been released and highlighting the fact that defaults are going up and what that signals for the economy as a whole. So, again, my name is Ryan Howell. I'm a business coach that works out of West Michigan and around the country, and I come to YouTube Live pretty much every single day to share information I share with my clients. This one's recorded. I am currently in Phoenix with my professional group, Pinnacle Business Guides. Be sure to go check them out if you're interested in that. So, with that, let's get into the article here. All right, now this is from Barron's. As always, the link is gonna be in the description, so be sure to go check that out. SBA loans are going bad, and internal risk analysis gives details. Um, TLDR, everyone expected this to start happening at some point. We just weren't saying it out loud. We knew that the COVID era uh, loans that were given and what the Biden administration did as far as loosening up the requirements to qualify for these loans was going to eventually result in a large number of defaults. So, all right, delinquencies and defaults have ballooned in the flagship lending program of the Small Business Administration, according to the risk analysis seen by Barron's ahead of the Senate committee hearing, which was yesterday. After again, they took a look at and examined why the program is losing money for the first time in 13 years. Iowa Republican Joni Ernst blamed the Biden administration's decision to cut its fees, which is a part of that, while loosening SBA lending rules and allowing loans by fintech firms for a jump in delinquencies and early defaults in the $116 billion guaranteed loans as a 7A program. Now, let me unwrap all that for you. In an effort to speed money to small businesses that were in need, the Biden administration basically cut the fees or eliminated them all completely for certain instances, and then they authorized non-standard banks to then also be handing out SBA loans. You know, you're not you're when they say fintech, so you're not traditional banks. Um, so the lending requirements were loosened, and the fee structure went down. So long story short is this program usually funds itself. N Not anymore. Now the last administration's 7A rules were the most drastic changes to the program in decades, Ernst has said. So SBA has been guaranteeing bank loans to small businesses since the Eisenhower administration, principally through the 7A program. Lenders made some $31.5 billion worth of loans under the program in fiscal year ending September 24th in amounts of $5 million and less. And that's really where it's at. That the program is meant to be for equipment, upgrades to your facility. It was always outlined in a way that you could to help you expand and grow your business. Like that's what it's there for. Again, in exchange for fees that have historically enabled the program to be self-funding. But in 2023, the SBA started cutting fees in an effort to expand access to the program. By 2024, a bank can lend up to $1 million under the program without paying a fee for the government's guarantee. No fee. So the federal government was bankrolling and basically guaranteeing these without having any money coming back in. The federal government basically took all of the risk without getting anything back. They're handing out taxpayer dollars without any sort of guarantee. That's what we're getting at here. And then that led to a year-over-year drop of more than $100 million in the NBA or the NBA's, good lord, the SBA's guarantee fees for the 12 months ended June 2024. So you can see that that's a significant amount right there. And so just look at that. So $100 million that they lost, right, didn't come in because of those fees. They would have loaned out somewhere north of $80 million of that. And so that's how many small businesses now weren't able to get money because of that. That's the idea. Now, as the agency was shrinking its revenue, the defaulted 7A loans that it was obliged to purchase ballooned, rising from this number 570 million in 2021 to 1.6 billion 3 years later. It tripled, ladies and gentlemen. The number of bad loans that we had to absorb in the federal government, what we as taxpayers had to eat it tripled. Um, that threw supposedly self-funding program into a negative cash flow that topped $370 million in 12 months ending June 2024. That is significantly that's awful. Now, an internal, SBA risk analysis report seen by Barron's notes that the Federal Reserve's 2022 rate hikes had raised default rates on every kind of variable. We're gonna come to that. That's an important piece. We're gonna come back to that. An agency processing fluke also shifted about 175 million in loan purchases into 2024 from prior years. People with the knowledge of the agency work verified the report's authenticity. So this is a real report. So let's talk about that piece with um, the effect of raising rates. So the rates didn't do what they were supposed to do. Um, but you still got the penalty. And what do I mean by that? So as the rates go up, it's supposed to disincentivize businesses from taking risky loans because of how much they have to pay back, and there has to be some calculus. And also, the banks become much more stringent on how they're lending to make sure that the money that's going out is, that they're going to get their return on capital. Um, and what ended up happening here is that since rates went out, but then they eliminated the fees, and then up to $1,000,000 with any fee period. There was really no risk for the banks to take on these loans. They could just send it out, and if they defaulted, the federal government had to buy it back had basically had to buy the bank out from it. Like, that's what ended up happening here, and that is really where the big concern comes from. Now, it wasn't that this was uh it wasn't that this was like a storm that was inevitable. It came down to the fact that people made a series of really dumb choices. Like, that's really it comes down to. When you look at this SBA program, it's supposed to be self-funding and take care of itself as it historically has. And because of the choices made by the Biden administration in the SBA at the time, I mean, I mean, almost $1.5 billion backwards. Like, that's just insane. All right. Now, committee's ranking Democrat, Senator Ed Markey of Massachusetts noted the importance of SBA loans to women and Black entrepreneurs who are more frequently denied bank loans than white male small businesses. Uh, which, yeah, I mean, they have a requirement for minority lending. It's one of the things I used to work in procurement with the government, and there are absolutely set asides for minorities, women, etc. Like, there's a laundry list of their disabled veterans, things like that. Um, that doesn't have anything to do with this though. Like, that's part that cracks me up. The overall rate of default in the 7A program during the Biden administration last fiscal year was similar to last year of Trump's first term, about 2.75%. The thing is, though, the volume was up. Like, that's the other issue. And when you also don't have the fees, that's the part that they don't talk about. Faults are moving up, which that makes sense, right? If you think about what we had going on in the last year with Trump, um, COVID, right? Everything was getting shut down and people can pay their bills, all right? That's an issue. It is the recent jump in early defaults that are concerning. Ernst responded, as well as the 7A program's negative cash flow. She put the blame on, again, binary relaxation of SBA lending standards. One witness agreed. Tim Fitzgibbon is a lending vice president at Ames, Iowa First National Bank, and he admires the intent of increasing loan access that motivated the SBA's 2023 changes, which made it easier for borrowers to qualify, but reduced underwriting standards in federally backed programs had contributed to the 2008 subprime mortgage crisis and more recent explosion of student loans. All right, we're going to stop there because that is the part that I want to be able to tie this into what I'm talking with my clients about right now. There, the era of cheap money has been over now for it started really in 2023, end of 2022 into 2023. It's just over now. And we aren't going back to low interest here in a little while because we still are dealing with inflation. So when I'm talking to my clients and especially with the entrepreneurs that I work with quite a few individuals who are looking to start businesses and get into their own, you know, again, start their own thing. And what I'm telling them is like, listen, you have a great opportunity right now to be able to get in with your sweat equity and make things work because there are a ton, and it's a large number. I would put just my back of the napkin math I have in my area. It's about 30% of businesses are struggling to make their loan payments right now. About 30%. It depends on service, retail, manufacturing. It varies, but that's around 30% of the folks that I've talked with. And What that means is they're gonna end up having a default, and there's gonna be some problems going on with them being able to make their loan payments, which is going to either bankruptcy, they're gonna have to close their business, downsize, which is going to give entrepreneurs great opportunity to come in because you don't have the overhead, you don't have all of these things to be able to come and start your business and get a strong foothold where while others who have the overhead and other pieces can't make it. So that's really where I'm talking with my clients right now. All of my clients, when I come in and start working with them, we do an audit. We do a full financial top to bottom. I want good numbers to be able to work with, and we pay someone they come in and shake them out. So we know exactly what we're dealing with as far as what we're leveraged at. Basically what's our loan to equity, where we're at, and so we can make better decisions. And in the case of this, what the SBA did, and this is the same thing government does, and they mess this up every single time. They want to increase access to to the financial industry so people can open businesses. Big fan of that. Let's do that. I think that's great. But they do it by lowering the standards and then absorbing the risk at the federal level. So what happens is the risk is still there, but we have not done our part, and I'm saying we collectively, at the federal level, at the bank level, at the underwriters to, speak up and say, "Listen, I know it's been lowered, but we we can't give you this loan because, right, it doesn't look like you're gonna be able to make the payments off of your whatever reason they have, and to be able to look out for these folks, and that's where we're failing the vast majority of, small businesses right now. So, again, links to this is gonna be in the description right here. Please go check this out, and again, if you'd like to learn more about how I help businesses grow faster than you ever thought possible, be sure to go check out summitbusinessguys.com. Take care, and I will see you next time.